You're probably familiar with Warren Buffett. He's one of the most successful investors ever. He's made a number of insightful comments over the years, many of which relate to this class. One of my favorites is, "Only when the tide goes out do you discover who's been swimming naked." That's not the one for this lesson, though. The one for this lesson is, wide diversification is only necessary when investors do not know what they're doing. Mr. Buffett is talking about two things: investor skill and breadth, or the number of investments. This lesson is about how investment performance relates to those two factors. In the 1980s, Richard Grinold was seeking a method of relating performance, skill, and breadth in investing. So for instance, you might be a very skilled investor, meaning that you can pick stocks well, but you might not have many opportunities or breadth to exercise that skill. So Grinold felt that there must be some equation whereby we could combine skill and breadth to create an estimate of performance. He developed a relationship he called the fundamental law of active portfolio management. I'm going to state it here at the beginning of the lesson and then spend the rest of the lesson trying to justify it and show you why it makes sense. And here's his expression. Performance is equal to skill times the square root of breadth. So we need some measure of skill and some measure of breadth. So if you want to improve your performance, you can improve skill, or you can find more and more applications or methods or opportunities for applying that skill. So as an example, breadth might relate to how many stocks you invest in, and skill relates to your skill at choosing them. So again, you can invest either in improving your skill or in improving your breadth. So performance is summarized in something called information ratio, which is very much like the Sharpe ratio that we've discussed before, but it refers to the Sharpe ratio of excess returns. In other words, the manner in which the portfolio manager is exceeding the market's performance. Skill is summarized in something called information coefficient, and breadth is just how many trading opportunities we have. Okay, so we'll expand on this more and more as we go through the lesson. Now we're going to explore these ideas in a thought experiment called the coin flipping casino. So instead of buying and selling stocks, we're going to flip coins, and we're going to bet on the outcome of whether those coins come up heads or tails. So that's analogous to a single investment in a stock or a single trade in a stock where you buy it and hold it, and either you make money or you lose money. Well, we're going to flip a coin and either make money or lose money. Now the coin is biased. In other words, we have information about this coin, and we know that it's more likely to come up heads than tails. And in fact, that probability is about 0.51 that it'll come up heads. So that's our edge. That's like our alpha when investing in stocks. And the uncertainty of the outcome is like beta in stock investing. Here's how betting works. So you can bet on any particular coin flip. You can bet in coins. If you win, in other words, it comes up heads, you now have 2 in coins. If you lose, they take your money. So this is called an even money bet. So on each outcome, you either make in coins or you lose in coins. Here's how the casino works. There are 1,000 betting tables, each with their own biased coin, and you have 1,000 tokens. So you can choose to bet however you like. In other words, you can put 10 tokens on each of 100 tables. You could put 1,000 tokens on one table. You could put 1 token on all the tables. Once you've distributed all your tokens, which represent your bets, the coins are all flipped at once. In other words, the game runs in parallel, and you, for each bet that you made, you either get your winnings or they take the chips that you bet. So now that we've set up this environment for us to experiment with, I want you to think a little bit about it and think about how would you allocate these tokens? Is it better to bet all your tokens on just one coin flip, or is it better to bet on multiple coin flips at once? So I want you to consider these two scenarios. two different ways to bet. In one case, you put all of your 1,000 tokens on a single table and 0 of your tokens on the other 999. So that's one way you might bet. And the outcome is going to depend on only what happens on the coin that's flipped on that single table. Another approach is to put one token on each of the 1,000 tables, and then all the coins are flipped in parallel, and you get your reward or loss that way. Which one of these is better, or is it the case that both of these are equivalent? Now, it would be fair for you to object and say, well, Professor Balch, what do you mean by better? I'll get on to that, but I think it's pretty clear, actually, that this is the best bet, and we'll spend some time explaining why. But the big picture is, this bet is very, very risky. There's a 49% chance you'll lose all your money with a single flip of the coin. Whereas in this case, your coins are distributed over 1,000 individual small bets, and there's very little chance you'll lose all your money. And furthermore, the expected return for each of these bets is the same. It's just that this one has much lower risk. To figure out which of these different scenarios is best, we need to consider reward and risk. Let's start here first with reward. So when we talk about reward in this situation, we're talking about our expected return. So in the single bet case where we bet 1,000 chips at once, our expected return is the chance that we'll win the bet times the return we'd get, plus the chance that we would lose the bet times what we would lose. So the chance that we're going to win is 0.51. Remember, it's a biased coin. And we have the opportunity to win 1,000 tokens or $1,000. The chance that we'll lose is 0.49 or 49%, and if we lose, we would lose $1,000. So if you multiply this all out and add it up, you end up seeing that our expected return is $20. I'd like for you now to figure out what's our expected return, or what's the reward, in the multi-bet case where we bet 1,000 individual chips on 1,000 different tables, and all those coins are flipped at once. All biased coins with a 51% chance of winning for us. What's our expected return in that case? So we make a bunch of individual bets. Each one has the same chances as this one up here, except each one of those individual bets only provides a loss of $1 or a gain of $1. So each of our individual bets has this 0.51 chance of winning $1 and 0.49 chance of losing $1. And we just have 1,000 of those. So if you work out the numbers, it turns out that this works out to be 0.02, and we multiply it by 1,000 and we get $20. So what's remarkable, or at least interesting, is that for both of these ways of betting, our expected return is exactly the same. So the reward side of this determining, which is better, is showing us that it's the same. So why should I say that this multi-bet approach is better? Well, it turns out that that's all about the risk. So let's look at the risk now. There's a number of ways that we might consider risk in this scenario. Let's look at first this idea of what's the chance that you might lose it all. So you put out your bets on the 1,000 tables, the coins are flipped. In that event, what's the chance you lose all of your money? In the single bet case, where you put all of your money on a single table and the outcome is determined by the flip of a single coin, remember, even though it's biased in your favor, there still is a 49% chance it'll come out against you. So if you put all your money on a single table for one coin, there's a 49% chance that you'll lose all of it. That's pretty high. I mean, consider that in the context of, would you put your savings account on a single bet like that? Now, I want you to think a little bit. Consider the multi-bet case where we put one token on each of the 1,000 tables. So there's 1,000 coin flips, and our return is determined by the result of all those individual 1,000 coin flips. What is the chance that we would lose it all in that case? Well, the answer to that is that it's the probability that we lose on the first table times the probability that we lose on the second table times the probability we lose on the third. And as you can see, we do this for all of the 1,000 tables and multiply those probabilities all together. And that's the probability we would lose everything in that multi-bet scenario. That is a very, very small number. It's 0.49 to the 1,000th power. How small is it? Let's try and calculate it on a calculator. So it's 0.49 raised to the 1,000th power. Let's see how small that is. It's so small, it's not even a number. That's how small it is. Okay, let's look at another way to evaluate risk. Another way that we can look at risk in this thought experiment is to consider the standard deviation of all those individual bets. So again, consider we have 1,000 different betting tables out there, and we have the opportunity to allocate our bets however we like. You know, we could put 200 tokens on one table, 5 on another, and so on. We're looking at the two extreme cases here, of course. But in any case, what is the standard deviation of the results of all those individual bets? So we're going to look at standard deviation after the fact. In other words, we're going to assume we bet already and we're looking at the outcome. So if we have 1 token per table, we might have a loss of 1 token on one table, a gain on another loss, and a gain, and so on, all the way across our 1,000 tables. Now, we don't actually have to spend much time doing the math here. It turns out that the standard deviation for this case is pretty easy to calculate, because for each table the result is either -1 or 1, and it turns out that the standard deviation in this case is easily calculated as 1.0. So it doesn't matter what the particular outcome turns out to be. We know we're either going to lose 1 or gain 1 in every single table, and so our expected standard deviation there is 1. The outcome for the second scenario, where we make 1 bet with 1,000 tokens and then essentially 0 bets on the other tables, turns out a little bit differently. So on this first table where we bet 1,000 tokens, we either win 1,000 or we lose 1,000. And on all the other tables, the outcome is exactly 0. Same for this case where we lost on that first one. So again, we bet on one table 1,000 tokens, and we bet 0 tokens on the other 999. Reasoning it out this way enables us to calculate the standard deviation. Whichever way it goes, whether we win or lose, the standard deviation on this event is the same, and the answer is 31.62. Key point here is standard deviation, or risk, is much, much larger, well, as you can see, about 31 times larger when we make that single bet on one table and no bets on the other tables. Now we're going to bring all these components together and consider risk-adjusted reward, and this is just like the Sharpe ratio that we've looked at in other contexts. In the single bet case, we can calculate this ratio easily like this. So remember, our reward, or our expected return, was $20, and our risk was $31.62. So if we divide this out, we get our Sharpe ratio, or just the adjusted risk-reward ratio for this scenario, and it turns out to be 0.63. I'd like now for you to fill in the numbers for the multi-bet case. In other words, the case where we put 1 token on each of the 1,000 tables and then get our return from that single event. So the reward or the return is the same, but remember the standard deviation or the risk was very much smaller. So we end up with a much larger ratio in the multi-bet case. So the take-home message here is, even though we have the same expected return, we can have much lower risk and thus a much higher risk-adjusted reward if we have many, many bets, 1,000 bets instead of just a single bet. So let's step back a moment and look at these results for these two extremes. So we had this one extreme where we bet all 1,000 chips on a single coin flip, and another where we bet 1 chip on each of 1,000 coin flips. Now the risk-adjusted reward, or the Sharpe ratio, for the single bet was 0.63. In other words, if we bet all 1,000 chips on a single flip of the coin, our Sharpe ratio is 0.63. So let's call this SR single. Now the Sharpe ratio, if we bet 1,000 times, in other words 1 chip on each of 1,000 tables, turns out to be 20. So what's the relationship between these two? Of course, 20 is about 40 times bigger than 0.63, but there's something more interesting there. And it turns out that it's this. So if we take the single bet case and multiply it by the square root of 1,000, we get the Sharpe ratio of our multi-bet scenario where we bet 1,000 at once. So isn't that curious? So it turns out that in general, if you carry this scenario out to more examples, that if you split your bets evenly across multiple tables, this relationship will hold. In other words, the Sharpe ratio for the single bet, 1,000 chips on one table, is sort of our base case, and as we spread it out over more and more tables, the Sharpe ratio improves by the square root of that number of bets. And this relation is exactly like the fundamental law of active portfolio management, namely our overall performance is related to the skill in the case of making a single pick times the square root of the number of picks that we're able to make. So our coin flip casino has helped to show us how we can derive an equation like this for betting, which is what buying stocks really is, and to show that you can improve things either by having more skill. In the case of coin flips, skill is how biased is the coin. In the case of investing, it's how good are you at predicting the future return of a stock. Or you can improve your performance by increasing your breadth, but you only get to improve it by the square root of your breadth. Consider now the results of this thought experiment. Our casino enabled us to allocate our 1,000 tokens to 1,000 tables. We looked at two extreme cases, one where we put a small bet on all 1,000 tables, and another where we put all our money on one table. We saw that the expected return was the same in both cases, about $20. But the risk was substantially higher for the single bet case. This was true for both types of risk that we looked at, risk to lose everything and risk as standard deviation. When we consider risk and reward together, we come away with three lessons. 1, higher alpha generates a higher Sharpe ratio. 2, more execution opportunities provides a higher Sharpe ratio. And 3, Sharpe ratio grows as the square root of breadth. Let's consider now the real world, and in particular hedge funds. So let's consider two real world funds. One is Rentech, or Renaissance Technologies. It was founded by Jim Simons, a math and computer science professor, and he's had tremendous performance over the last several decades. And Warren Buffett, who runs Berkshire Hathaway. Both of these funds over the years have produced similar returns. But on the one hand, Warren Buffett holds maybe 120 stocks, and he doesn't trade much, he just holds them. Renaissance Technology trades maybe 100,000 times per day. Can a single theory relate these two? Can it account for the vastly, widely differing numbers of trades per year? And can it relate the fact that they have similar performance and maybe different levels of skill? How does that all work together? Well, yes, there is a theory that can relate them. It's the fundamental law of active portfolio management, and I'm going to show it to you in just a moment. Before I introduce the fundamental law, I've got to define a few terms. Let's start with information ratio. So recall, the return on our portfolio for a particular day is equal to the market component of the return, which is beta for that portfolio, times the return on the market for that day, plus this residual return. Another way to look at that is to say that this component of the return is due to the market, and this component is due to the skill of the fund manager. Remember, alpha is about skill. Now we want to focus on the skill component. In other words, what is the fund manager bringing to the table? And we can calculate the Sharpe ratio, essentially, of this component, just like we can calculate the Sharpe ratio of an entire portfolio. But we can focus on this skill component, and essentially the Sharpe ratio of this skill component is the information ratio. It works like this. So the information ratio is the mean of all of the alpha components divided by the standard deviation of the alpha components. So this is our reward component, that's our risk component. And by the way, this is calculated by looking back historically at the daily values of alpha, and we take the mean and the standard deviation of them over time. You can find these by finding beta for the portfolio, calculating what the market return component was for each day, and then the difference is this residual or skill. So that's how you can compute historically the value of this information ratio. Now, by the way, this information ratio applies in many different cases, not just in this fundamental law case. People use information ratio as a measure of manager performance all the time. It's fair to say that information ratio is essentially a Sharpe ratio of excess return, this part that's due to skill. IC, or the information coefficient, is just the correlation of the manager's forecasts to actual returns. So for instance, if she made a forecast on IBM that it would go up 1% and it went up 0.5%, well, that's a positive correlation. This value can range from 0, where the correlation is not present, to 1, where it's very, very strong. Finally, BR, or breadth, represents the number of trading opportunities per year. So for example, if you're Warren Buffett and you hold 120 stocks and you just hold them all year, that's 120 trading opportunities. If, say, you're Jim Simons and you trade 100,000 times per day, you multiply that times the number of trading days in a year, well, it turns out to be a very large number. Key thing is, even if it's just a portfolio where you buy and hold, you count the number of positions in that portfolio as the number of trading opportunities, because this is oriented around an annual measure. Now that we've introduced these factors and defined them, we're now able to describe the fundamental law as expressed by Richard Grinold. And it's simple. It's just this. He was able to show mathematically that information ratio is equal to information coefficient times the square root of breadth. I'm going to just present it without proof here and encourage you to go look at Grinold's book if you're interested for more detail. So performance of the manager or the fund is due to the skill at making predictions times the square root of breadth. So that means, for instance, that yes, you may be very skilled, but you've got to have opportunities to invest in order to operationalize your skill. Now, if you want to improve your performance, you can either focus on improving your skill or focus on improving your breadth. Sometimes it turns out that it's a lot easier to increase breadth by finding additional stocks that you might look at or additional markets. You might have some commodity trading strategy that works great. You can increase your breadth by looking at additional commodities. However, the strength of this increase, in other words, as you increase breadth, the overall performance only increases as the square root of that breadth. So it tapers off after some amount of time. It turns out, though, that it's very, very hard to improve your skill. So that is why, for instance, folks often focus on the breadth component of this equation. Let's get back to that original question that motivated some of this, which is how can we relate the performance of Renaissance Technologies, or Jim Simons, versus Warren Buffett? And the quiz here is for you to use the fundamental law to see if you can relate the two. Okay, so for this problem, assume that both Simons and Buffett have the same information ratio. I'm making that up. I don't know for sure that they do, but this is just a simplification for this problem. Assume that Simons' algorithms are only 1,000th as smart as Buffett. So that's another way of saying that their information coefficient is 1/1000th the value of Buffett. Also assume that Buffett trades 120 times per year. Given that, how many trades must Simons execute in order to maintain the information ratio at the same level as Buffett? The answer is 120 million. So if Buffett trades only 120 times per year, Simons has to trade 120 million times. So here's how I arrived at that. We know that their information ratios are the same, so we just set the equation equal to each other, one for Simons and one for Buffett. So the information coefficient for Buffett times square root of 120, this is Buffett's information ratio. Now this is Simon's information ratio. It's his information coefficient times the square root of x, which is what we're trying to find. Now first thing we can do is replace ICS with what we know that it's 1/1000th of Buffett's. Now we can multiply both sides by 1,000 and divide both sides by Buffett's IC, and we get this. And now we just square both sides and we're left with x, or 120 million. Okay, that's it for the fundamental law of active portfolio management. I'll see you again soon. Thanks.